News9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. In the studio with me, my colleague Suyash, Maheshwari. Suyash, good morning. Markets opening in green this morning.
Yes, markets witnessed a strong start to the week with Nifty opening above the 19,800 mark. Now, this is on the back of a positive handover from the US and European markets. Now, US markets closed with significant gains. All three indices, the S&P 500, Dow Jones and Nasdaq posted gains of about 1% in yesterday's trade. European markets were buoyant as well. Asian markets also opened in the green this morning. Now, this is also like the Indian markets are also witnessing a surge because Brent crude has softened slightly. It has fallen below the $90 barrel mark amid reports that, perhaps US is going to lift sanctions on Venezuela. So that has eased prices or oil prices, and which has also given some sort of strength to the Indian markets. Now, currently the Indian markets are trading above the 19,800 mark. Sensex is also up about 300 points and is sitting at 66,500 mark. The broader market, Shweta, are also buoyant with Nifty small cap index trading 1% higher and the mid cap index trading about 0.6% higher. Now, talking about sectors, all sectoral indices barring Nifty Realty are in the green this morning. Now, both Nifty Bank and Nifty PSU banks are trading with good set of numbers. Like Nifty Bank is up about 0.6% and it is hovering around the 44,500 mark, whereas the PSU banking index is up about 0.75% this morning. Other sectors that are in focus this morning are also the Nifty Metal Pack, which is up about 0.84%, Auto Pack, which is up about 0.5%, and the FMCG Pack, which is also up about 0.5%.
All right, that is as far as markets is concerned. Let's quickly get in Ambareesh Baliga joining us on the show at this point in time. Mr. Baliga, thank you very much for taking time out. It's a bright start to a Tuesday morning. Markets up 0.5%.
That's true. I mean, the markets have been on a roll for a while now. Despite the Israeli conflict, we had the fall for a day or two. But then after that, I think liquidity has been driving the markets up. And this is despite the rupee turning a bit weak. Oil is still a risk. Although we have seen oil correcting to a certain extent, but that still remains a risk. So as of now, clearly, I think it's liquidity which is driving it.
Okay, liquidity driving it. Suyash, talking about liquidity and talking about crude oil prices, I mean, crude oil is something we've tracked very, very closely here. Does it look like worst may be over for crude oil just as yet? I mean, I'll take that question to Mr. Baliga also. Mr. Baliga, crude prices inching up gradually, slowly. There are fears that it will head towards a $100 per barrel mark. Hasn't happened so far. What are the possibilities in your understanding that $100 mark will be touched anytime soon? Would you expect prices to ease up now that we have seen perhaps the worst of what Israel war could have done or would have led to?
No, I don't know whether we have still seen the worst of the Israel conflict because clearly I think that will go on for a while. I think the only fear which could be there is whether it will broaden. Okay. I mean, if it remains at the Gaza conflict, I think that is, that's something which the markets could accept, just like how the markets have accepted Russia-Ukraine war, which has been on for more than a year now. So in case it broadens, I think that's the only risk the markets have to look for. And in case it broadens, you'll see the oil prices climbing up.
Now, Mr. Baliga, the last time you were here when Nifty was hovering around that 19,500 mark, you made a bold prediction that, we could see perhaps Nifty slip to 18,500 sort of levels. Is that
before it scales up to 20,000? Yeah. We remember, I think just... yes, Mr. Baliga.
I stuck my neck out and said that possibly we should see 18,500 levels before it touches 20,000.
Would you still agree with that?
I would still stick to it. Because whatever said and done, I mean, the move which we have seen in the past few days hasn't been a very strong move. I mean, we have not seen too much of a participation. It has moved up, no doubt. I mean, that's clearly there on the figures which we are seeing. But then it's not really been a very broad move, and the participation seems lesser than what it was in the past. And like I've been saying earlier, I mean, the problem is not there with the Nifty stocks or the large caps. The bigger problem is there with the small and the mid caps, where most of the retail money is there. And that's where the volatility is huge. And in any sort of a correction, I think the retail and the HNI investors, would actually get affected the most. Because if you look at the large caps, yes, I mean, there are issues, but that's only in certain pockets. Like, for example, defense and railway stocks among the large caps. I mean, they have, I think they are too overrated, and the valuations are quite expensive. And that's where the correction would happen. But the rest of the large caps, the correction may not be too huge.
Okay. Before I let my colleague Suyash come in, we're looking at small caps and large caps still underperforming the headliners. Is the market already factored in what it could as far as small caps, mid caps is concerned, or are you looking at perhaps a further divergence from the performance of the broader markets as far as small caps and mid caps is concerned? Look at the performance today. Small caps up 0.94%.
That's to me.
Yes, that is to you, sir.
See, the small caps, if you look at, in those pockets where we have seen huge outperformance, I mean, so many of them have become multi-baggers. And after becoming multi-baggers, even if it corrects 10 to 15%, it's hardly anything. So when we talk of a correction, we're talking of a much larger correction. I mean, a stock which has possibly moved from 20 to 100, I mean, that falling to 90 is nothing much. But then when it falls to levels of 50, 60, that is when a lot of people get hurt, because most of the retail or the HNI crowd gets into these stocks after they have become multi-baggers.
Okay.
Just because the momentum is on, I mean, they bought it at those higher levels, and from there the correction is decently large.
So, will you advise investors, especially the retail investors, to be cautious as far as the small cap and the mid cap indices go? Because we have also seen volatility spike up lately because of the war that's playing out, because of the uncertainty that prevails in the global markets.
Absolutely. I think one has to be extremely cautious at this point of time. Don't go after momentum. I mean, unless you're a trader and you are used to keeping very strict stop losses and you actually abide by that. I don't think one should be trading in the small cap and the mid caps from an investment perspective at this point of time. Because like I said, when the correction happens, it can be decently be huge, and that will hurt a lot. So I think one has to be extremely cautious, look at the valuations, because the way I see, I mean, across, especially, on the retail side, most of the people are not even looking at the valuation. People are just looking at momentum just because the stock is moving high into it. Yes, I mean, they are quite lucky at times because of momentum, they make money and are able to exit. But the problem happens when the exit stops, because when when the market start moving down, the liquidity is drawn out from the mid cap and the small caps, and that's the time they find it extremely difficult to sell. And also psychologically also, I mean, if you have seen a higher level, it becomes quite difficult for most of the people to sell at lower prices. I mean, if you're bought at 60, it goes to 100 and then comes down to 80, you find it difficult to sell at 80 unless you're forced to.
Now, Mr. Baliga, before we move on to stocks, also want to get your view on the banking pack. Now, Nifty Bank is trading with good profits today, like it's up about 0.6% above the 44,500 mark. And we have a lot of earnings coming from the banking and the financial space this week. Yesterday, we had HDFC Bank, Bank of Maharashtra. We also have ICICI Bank, Kotak Mahindra Bank lined up. So in light of that, do you expect that the banking index could show strength given that it has underperformed and make that dash to that 45,000 sort of mark?
I doubt that because, like I've said in the past, I think the best of the banking pack, I think we have seen that in Q1 of FY24, which is last quarter. I think the NIMs have more or less topped out. I think the only space for outperformance could come from the slightly smaller banks, where there has been a delay in terms of, the earnings showing up. So I think some of the smaller private sector banks and the PSUs possibly may show a better performance in Q2 as compared to Q1. I think we've already seen that as far as Garu Vesa Bank is concerned. And I really don't expect the large caps, both in the PSUs as well as private sector banks, to show a better performance as compared to Q1. So if you're talking of the index overall, I really don't see a performance from here, because again, I mean, that is more heavy as far as the large caps are concerned, where I don't expect a performance.
Now that, you certainly expect the larger banks to underperform compared to the smaller banks, but what about the PSU and the private banking space? Which one will outperform this earnings season?
I don't think either of them will outperform. I think you will see pressure as far as the margins are concerned for both the large PSU banks as well as the large private sector banks.
All right. And since we're talking about banks, important to mention India's largest private lender, HDFC, came out with its results last evening. Suyash, run us through the numbers.
Yes, I mean, Shweta, having had some time to look at the numbers, sit with the numbers and read the management commentary, to me at least it seems that the results are better than what the street was factoring in, or at least better than, what the management commentary had suggested a month ago, during its analyst call. Now, before we talk about the numbers, it is important to point out that the Q2 numbers are not comparable on both year-on-year basis as well as quarter-on-quarter basis, because these results are of the are after the merger of the entity. So these numbers will not be comparable, and also both the banks like HDFC Bank and HDFC, the business model was different. So A plus B does not necessarily makes it AB. It could be C, right?
Okay, so let's quickly get in Mr. Baliga on that as well. Mr. Baliga, over the last 12 hours since HDFC came out with its results, we've seen comparisons being made in the media itself. Would it be fair to say that such a comparison is not warranted, given that this is a merged entity and you're talking about results of individual entities as of last quarter? Is there even a room for comparison?
No, I really don't think there's much of a room for comparison because 1 plus 1 here does not really mean 2, especially in the initial period when the merger is going through. Because end of the day, it's the people and the systems which are being merged, and typically in such cases, especially when we're talking about the larger companies, there is some amount of slowdown because there are changes happening within the system. So at least for 2 to 3 quarters, you'll see some amount of slowdown. So 1 plus 1 will be less than 2. But then post that, you'll actually see the performance happening. So I think one needs to wait for at least 2 to 3 quarters to really see performance from HDFC Bank.
Okay.
And the other thing which I would like to add out here is that always when you look at the quarterly earnings, it is always expectation versus delivery. So here, I think the expectations were set right by the management about a month back when we had the conference call, and the expectations were decently low. I mean, it was reduced, and because of which we saw the stock correcting also decently well, and the earnings were better than what we had expected. So that's one of the reasons why we're seeing quite a few of those positive notes coming from the brokerage houses.
Now, Shweta, let's quickly run through the numbers. Now, net profit came ahead of the street's expectation. The street was factoring in a net profit figure of about 14,780 crores. This time around, the profit came in at 15,976 crore, which means it's 8% higher than what the street was estimating. Now, net interest income came in lower, which by about 2.5%. The street was factoring in somewhere around 28,089 crores, whereas the number net interest income stood at 27,385 crores. Now, looking at the other numbers as well, the total loan book stands at 23.5 lakh crore, which on a pro forma basis is about 4.9% higher, meaning if we add HDFC and HDFC Bank directly. Total deposits, on the other hand, were up sequentially by 5.3% to 21.73 lakh crore. Now, net interest margin, Shweta, came in at 3.4% compared to the long-term average of 4%. Now, reading into the management commentary, the management said the dip was largely due to the higher cost of borrowing for the HDFC Bank, and over time, once the high cost debt is retired, the bank will replace it with retail borrowing, and then the NIMs will improve. Also, gross NPA stood at which came in at about 1.34%. The management said that around 22% of it of this portion is from the performing, as well as they were reclassified as NPAs, but these assets are performing. So if we remove that effect, it's pretty much around the last quarter's earning. So I mean, as Mr. Baliga, you said that the results are better than what the street was factoring in, but I'm looking at this net interest margin figure of 3.4% versus the long-term average of 4%. After the management commentary, when do you expect that this normalization to happen? When do you expect the bank to finally get to that 4% mark?
See, this NIMS also fell because of the merger. And I expect, at least as far as HDFC Bank is concerned, the NIMS can move up a bit. I don't think they'll move back to 4%, but I think they can move up about, point 0.3, point 0.4, maybe in the next 2 to 3 quarters. That's why I said I think we should wait for those 2 to 3 quarters for the performance to really show up.
And what's your take on the stock, sir? The stock is up about 1% this morning. It has been
Right.
consolidating around 1530 mark. So good bit of a movement there.
See, I mean, I don't see a major move in HDFC Bank, but as far as the like downside is concerned, I think that's over. So if one has enough amount of patience, then one could look at buying it at this point of time. Otherwise, there's no hurry to buy. But then, as far as the long-term portfolio concerned, this is a good stock to hold on.
All right, let's quickly also move on to another stock that we are tracking, Jio Financial Services. In fact, JioFin came out with its quarterly earnings last evening. Surprisingly, net profit up 101% quarter on quarter without an actual, understanding of what the business model is. How do you explain these numbers, Suyash?
I mean, the 101% rise looks glorious, right? But let's break it down. Let's hold our horses there. Now, this was the first quarterly announcement from the company after its listing back in August. Now, the new company is yet to start the business. So, the numbers that are trickling in, at least as far as Q2 is concerned, is from its old subsidiaries, its associates, as well as its joint ventures. Now, if we look at the numbers, Shweta, broadly, the profit figure, of course, grew by about 101% on a quarter on quarter basis to 668.18 crore. Now, this growth was supported in profitability, was supported by a dividend income of about 217 crore and additionally a dividend income from associates of about 154 crore. But again, this 101% rise we are seeing, I was actually studying the financial statements released by the company, and one of the things that caught my eye was that cash flow from operations, in fact, for the previous quarter was negative at around 132 crore. So the company is actually incurring losses from its operations. Now this is okay because the company is actually not doing any business as of yet. Now the profit that we are seeing of about 608 crore rupees comes from the investing activities, which is by the way of dividends from both associates as well as its parent company Reliance Industries. So Mr. Baliga, I mean, what sort of a weightage would you even give to the results of Jio Financial results? Is it an event for the stock, or is it a complete non-event, considering that we don't even know what the newly minted company is going to do going forward?
I think we have to take it as a non-event because it doesn't make any sense discussing the earnings of Jio Financial because there is actually no real business in the company right now. I mean, all that one is betting on is the group and the deep pockets they have and the sort of a disruption they have brought into retail and telecom. I mean, people are expecting a similar sort of a disruption happening in the financial services market going ahead with the Jio Financial. So as of now, I don't think these earnings make any sense at all because end of the day, most of the revenue is from dividends, and this was a dividend season, and that's why that's one of the reasons why the dividends have come in. So I don't think we should give any weightage to it. I think one should look at Geo Financial possibly a year or 2 years down the line if you really want to discuss the financials. I mean, right now it's a story.
Okay, and reading the management commentary, when do we expect operations to finally kickstart? Any clarity on, there's going to be, of course, a regulatory challenge, an insurance regulator, an AMC regulator, a whole host of regulatory clearances that the company will have to take. What sort of timeline are we looking at before the operations kickstart?
I think we should safely look at possibly Q2 of FY25 for the operations to really kick off.
Q2 of FY25, that's the timeline Ambareesh is putting to it. But while we're at it, let's also take a look at other stocks that we're tracking, Suyash.
Certainly, Shweta. So among the Nifty 50 companies, Bajaj Finance is going to also come out with its Q2 results during the day. Now, the net profit is expected to rise by about 30% on a year-on-year basis to about 3,600 crore from 2,780 crore in the year ago period. Net interest income is also expected to rise by about 30% year on year, and sequentially it is expected to rise about 7%. However, the asset quality as well as the net interest margins are expected to come under pressure. Net interest margins because of the higher cost of debt that the company is facing. Sir, I mean, we have seen a good bit of movement in Bajaj Finance stock. I think in the last 1 month or so, it's up about 7%. It also did a fundraising round where it raised about 10,000 crore or so. I mean, we have also seen other NBFCs, you know, come out with the fundraising. So
I mean, they're shoring up their books.
They are
preparing for the competition ahead.
They have to, I think, before Jio Financial really starts their business, I mean, all of them will have to show their books and garner as much market share as possible. And talking about Q2, I think, the figures which have been released by the management earlier on the AUM growth of about 33% Y on Y, about 7.5% Q on Q, I think is decently
PVR?
good. Yeah, and I think, I mean, with this, possibly the earnings also should show a decent move. And because the momentum is there in the market, the stock can actually move up more from here.
Sir, I was reading at the brokerage views, like they have a target as much as 10,000 rupees. Now, do you expect that sort of an upside, like 20-25 upside from here on?
No, frankly speaking, in a market like this, it's quite difficult to really see as to where the stock can go and stop. But I mean, looking at the valuations, even giving it the best possible valuation, I mean, I really will not give it more than 9,400 to 9,500 levels.
And as far as the competition goes, who do you think will give Jio Financial the toughest competition? Among the likes of Cholamandal, Aditya Birla, Bajaj Finance.
I think the closest which can come would be Bajaj Finance. So I think, I mean, the highest risk is also there for Bajaj Finance because the way they have performed in the last so many years and the sort of premium valuation which they're getting from the market, I think that could be at risk.
All right, that is as far as competition in NBFC space is concerned. Ambareesh, thank you very much, sir. Thank you for taking time out for joining us here on News 9.